A wealth tax is a concept that often surfaces in policy debates. Let us break down what it actually means for taxpayers. Unlike an income tax, which taxes what you earn, a wealth tax is a levy on the total value of assets you own. The tax is typically applied to your net worth. This includes things like real estate, stocks, and cash, minus what you currently owe. Wealth taxes are rare because they require accurate, annual valuations of every asset you own, which is a complex administrative task. It is important to distinguish this from income tax. Income tax hits the money coming in, while wealth tax hits the pile you have accumulated. Proponents argue it addresses wealth concentration, while critics point to difficulties in valuation and potential impacts on liquidity and investment. Ultimately, tax policy is always a debate about how to fund public services while keeping the economy running efficiently. Understanding these concepts helps you stay informed on tax policy discussions. Like and subscribe for more basics on money and taxes.